Okay, let's get into this. We're doing a deep dive today on Chewy, the big online pet retailer, ticker CHWY. And there's a bit of a head-scratcher right out of the gate. Chewy just dropped their Q1 2025 results, and look, they didn't just meet expectations, they actually beat them, both on sales and profit per share. So you'd think, logically, the stock price goes up, reflects the good news.
Absolutely. That's typically what happens. A beat like that usually signals strength, and the market tends to reward it.
But here's the twist, the thing that caught our eye in the source material, and we're looking at their Q1 earnings report and the conference call transcript here. The stock price actually fell, dropped right after the announcement. So that's what we're digging into today. For you listening, we want to unpack these numbers, figure out the key performance stuff, look at the strategies they're using, and really try to understand, well, why did the market react like that to what seems like a win? Let's jump in.
Right. So starting with those top-line numbers from Q1. Straight from the report, net sales landed at $3.12 billion, which was, higher than the $3.08 billion analysts were forecasting. And it's also up 8.3% compared to the same time last year.
So sales are definitely moving in the right direction.
Yeah.
What about profit, the bottom line?
Yeah, so the company focused on their adjusted figures. Adjusted earnings per share, EPS, that came in at $0.32. That beat the forecast of $1.32 by about 9.4%.
Okay, another beat.
And then there's adjusted EBITDA. That's a pretty common metric, for operating profitability before interest, taxes, depreciation, amortization.
Right.
That number was $192.7 million, which translates to a margin of 6.2%. And that margin itself was up about 50 basis points year over year.
And just quickly, basis points, we're talking 0.01%, right? So 50 basis points is 0.5%. Small number, but can be pretty significant for margins.
Exactly. And they also generated free cash flow of $48.7 million during the quarter. Now, it's important, like you said, to look at the standard accounting figures, too, the GAAP numbers. Under GAAP, net income was $62.4 million. And that worked out to $0.15 per share, both basic and diluted.
And the sources mentioned this wasn't just a fluke, this Q1 beat. Chewy's actually been making a habit of exceeding forecasts recently. That says something about how they're running things.
It really does. And about those adjusted numbers we mentioned, adjusted EPS, EBITDA, free cash flow, the sources do remind us these are non-GAAP. They leave out certain costs that are in the GAAP figures, things like stock-based compensation, depreciation, severance sometimes.
Right. Management uses them to show a specific angle on performance, maybe core operations or cash generation.
Yeah, but it's crucial for you, the listener, to know it's a different picture than the full GAAP results. They have their uses, but also limitations.
Okay, which circles us back to that weird market reaction we started with. Despite beating estimates, the stock took a hit, down 6.49% in pre-market trading, settling around $42.82. Why? What were the explanations floating around in the sources for this disconnect?
Well, a few possibilities came up. One is just, typical investor psychology, maybe some caution setting in, maybe folks just taking profits after a run-up before the report.
Standard market stuff.
Could be. Another angle mentioned was valuation. There was some analysis cited by Investing Pro suggesting the stock might have been trading near its, quote, fair value. So even with good news, if the stock isn't seen as cheap going in, the reaction might be muted.
And what about the specific valuation metrics, like the price-to-earnings ratio, the PE?
Right. That was noted at 49.31, which, for some investors, that's a pretty high multiple.
Suggests the price is already baking in a lot of future growth.
Exactly. So if the results are good, but maybe not blowout amazing, a high PE can limit the upside. The sources also flagged the stock's volatility. Its beta was 1.75.
And beta, just to clarify, measures how much a stock tends to move relative to the overall market. 1.0 is average. So 1.75 means Chewy historically moves 75% more than the market does, up or down.
Yeah, higher sensitivity, which can mean more perceived risk, especially if the broader economy feels a bit shaky. That contributes to that mixed feeling around the stock.
So you've got this contrast. Strong operational results inside the company, but maybe some external headwinds or valuation concerns putting a damper on the stock reaction.
Precisely. But let's push past that market noise for a minute and look inside Chewy, because the sources really paint a picture of a company executing well, making smart strategic moves. Let's get into those growth drivers.
Yes, please. What's actually powering this performance underneath?
Okay, first off, customers. They finished Q1 with 20.8 million active customers. That's up 3.8% from last year. And importantly, they added about 240,000 net new customers just in Q1.
So how are they doing that? Getting new people in and keeping them from leaving?
The CEO talked about better execution, more effective marketing, bringing in more gross new customers, and also better gross churn, which just means fewer existing customers are leaving. Retention is improving.
That's key.
And they also stressed the quality of the customers they're acquiring now, especially those who joined, say, in the last year and a half. They're showing better reorder rates, higher lifetime value potential compared to pre-pandemic groups.
Interesting. Focusing on quality, not just quantity.
Seems to be the case. And the foundation for all of this, the real engine for Chewy, is that autoship program.
Yes, the subscription model.
It's absolutely core. Autoship customer sales jumped almost 15% year over year, hit $2.56 billion. And get this, that's now a record 82.2% of their total net sales.
Wow. Over 4/5 of their business is recurring. That's predictability right there.
Huge. And the way they get people onto autoship, according to the sources, starts with just nailing the basics. Have the right products, keep them in stock, ship fast, make returns easy. Retail 101.
But then how do they keep them locked in?
That comes down to the personalized website experience, their high-touch customer service, the convenience and value of the program itself, and increasingly adding other complementary services around it.
Speaking of other stuff, hard goods apparently had a really strong quarter. Things like crates, toys, beds.
Yeah, that category stood out, grew 12.3% year over year. Pretty impressive.
What was behind that surge?
They pointed to a few things. Refreshing the product selection, they added over 150 new brands recently. And they apparently sped up their internal process for getting new items listed online, cutting the time by like 40–50%.
Streamlining things.
Seems like it. Plus, better inventory management, making stuff easier to find on the site, and just a better personalized experience overall. Every subcategory within hard goods was up.
Okay. And they also launched their Chewy Plus membership program officially now, right? It was in beta before.
Correct. Moved out of beta, it's now a paid program. It's $49 a year after a trial. Members get benefits like free shipping on more orders, 5% back-end rewards on certain things, exclusive deals, stuff like that.
How's it going? Still early days, I guess.
Yeah, definitely early. But they reported strong initial membership growth, positive feedback, and critically, the members they have signed up are way more engaged.
Engaged how?
They visit the site more, they order more often, they buy across more categories, higher frequency, broader purchasing, and this is apparently driving incremental contribution profit.
Contribution profit, meaning these members are bringing in more revenue than the direct costs associated with serving them, adding directly to the bottom line.
That's the idea. They see Chewy Plus as working with autoship, not replacing it. It's another layer of loyalty, maybe appealing to customers motivated more by rewards and deals than just the set-it-and-forget-it convenience of autoship.
Makes sense. Now, the other big strategic push is Chewy Vet Care, CVC, the physical clinics. How's that expansion progressing?
They're moving steadily. They've got 11 clinics open now, spread across 4 states. The plan is to add another 8 to 10 this year. So they expect to end the fiscal year, FY25, with somewhere in the high teens for total locations.
And how are the existing clinics doing?
Performance is apparently beating their own forecasts. They're seeing growing usage, strong forward bookings, people are scheduling appointments.
But the real kicker, strategically speaking, based on the sources, isn't just running the clinics themselves, it's how they connect back to the main Chewy business, right?
This is where it gets really interesting, yeah. They're finding the clinics are acting as a significant source of new customers for the whole Chewy ecosystem, more so than they initially modeled.
How does that work?
Get this. About half of the pet parents who bring their pet into a Chewy Vet Care clinic end up making a purchase on Chewy.com within 30 days.
Wow, that's a direct pipeline from service to retail.
Exactly. They described it as building a highly defensible moat. It's not just about selling products anymore. They're creating this integrated system. Retail, pharmacy prescriptions, and now healthcare.
It widens their potential market significantly.
Totally. They're looking at the $20–25 billion vet services market itself, but also potentially beyond that into pet health tech, maybe insurance, leveraging all the data they gather across these different touch points. It's a bigger vision.
Capturing more of that total lifetime spend on a pet. Okay, what about the sponsored ads business? The sources flag that as a big profit driver.
Oh, absolutely. Huge for margins. This is where brands pay Chewy to feature their products on the site. It's performing really well, growing sequentially. A key thing they mentioned was successfully moving to their own internal advertising platform. They called it a 1P platform.
Meaning built in-house, their own tech stack, not relying on a third-party ad tech provider.
Exactly. And this new platform lets them offer more types of ads, video ads, self-service tools for the brands, and importantly, off-site ads.
Off-site. So ads for pet products, but shown on other websites or social media, not just on Chewy.com.
That's right, and apparently the demand from brands for those off-site placements is running ahead of what Chewy expected. And the ROI, the return on investment for the brands buying those ads, is also exceeding expectations.
Because it's advertising, the margins on that revenue are typically very high, right?
Extremely high. So that business is a major contributor to improving their overall gross profit margin.
Okay, so strong operations, smart strategies driving growth. Let's pivot back to the overall financials, health, efficiency, capital management. What did the gross margin look like this quarter?
Q1 gross margin came in at 29.6%. Now, on paper, that looks like a tiny dip, down 10 basis points from last year.
Ooh.
However, the company pointed out that Q1 last year had about 70 basis points worth of one-time benefits boosting it. So if you adjust for that, the underlying margin this Q1 was actually up about 60 basis points year over year on a like-for-like basis.
Ah, okay. So the core profitability per sale is actually trending upwards. That's important context.
Definitely. And the drivers for that improvement, like we touched on, are mainly that high-margin sponsored ads business growing, the efficiency of auto-ship, and just a favorable product mix. They actually expect gross margin to improve sequentially again in Q2.
What about operating costs? SG&A selling, general and admin expenses, and marketing spend.
SG&A was up 8.4%. The sources said part of that is tied to expansion in the new Houston fulfillment center, building out the pharmacy network, also some costs from return to office stuff. But they are forecasting what they call modest SG&A leverage for the full year.
And leverage here means they expect those SG&A costs to grow slower than sales grow over the full year. So as a percentage of sales, SG&A should slightly decrease, signaling better efficiency.
That's the goal, yeah. Better efficiency as they get bigger. Advertising and marketing spend was up 3.7% in Q1. They expect the full year spend to be pretty consistent with past years, around 6.7% to 6.8% of sales. Q1 was a bit lower percentage-wise just due to the timing of some campaigns.
And their balance sheet, cash position, debt. Sources made it sound pretty solid.
Very solid. They ended Q1 with $616.4 million in cash and equivalents. Plus, they have this $800 million asset-based lending facility, an ABL that's completely unused.
An ABL is basically a credit line backed by their assets, like inventory.
Correct. And they have $782.8 million available under that line. Zero drawn down. They're completely debt-free. Management sounded confident they have plenty of liquidity to fund everything they need to do.
And that free cash flow number, $48.7 million in Q1. How are they using that cash?
Two main things, according to the sources. First, reinvesting back into the business via capital expenditures, or CapEx.
CapEx being spending on long-term assets, building fulfillment centers, vet clinics, technology upgrades, that kind of thing.
Exactly. They expect CapEx for the year to be around 80% of their adjusted EBITDA converted into cash flow. The second use of cash is returning it to shareholders through their share buyback program.
Right, they have a $500 million authorization for that.
They do, and in Q1, they spent $23.2 million buying back shares. So there's still about $383.5 million left under that program.
So generating cash, investing in growth, and buying back stock. Okay, looking forward, what's the guidance for the rest of the year, and what risks did they highlight?
For the full fiscal 2025, they're guiding for net sales between $12.3 billion and $12.45 billion. That translates to 6% to 7% growth year over year, once you adjust for an extra week they had last year. And given the strong Q1 start, they said they're trending towards the upper half of that range.
And profitability, the adjusted EBITDA margin.
They kept the full year outlook the same there, 5.4% to 5.7%. The middle of that range implies about 75 basis points of margin expansion compared to last year, so improvement expected for the year overall. They did caution, though, that margins will likely dip sequentially after Q1. That's partly due to normal seasonality in the business and partly the timing of investments they plan to make later in the year.
Did they give any color on the overall pet market itself?
Yeah, they estimate the total market is growing maybe 3–4%.
Yeah.
Chewy clearly sees itself continuing to steal share within that market. They used to figure like they're capturing about 50 cents of every dollar that moves online in the pet category.
Wow. And pricing trends, inflation.
They're seeing pretty low like-for-like inflation on products, but they did mention this ongoing premiumization trend, people trading up to higher quality, often more expensive pet food and treats. They don't foresee major impacts from tariffs, partly because a lot of their supply chain is domestic, and any potential impact is already factored into their guidance. Oh, and they mentioned seeing strength in both the dog and cat categories.
Okay. And what about specific risks or challenges mentioned in the sources?
The usual suspects for a big online retailer. Potential market saturation, how much more growth is there just from shifting online? Competitive pressure, obviously. Macroeconomic worries impacting how much people spend on pets. Supply chain risks are always there. And tariffs, while seen as minimal, are still a factor. They also specifically noted the planned departure of their CFO as something to be aware of.
Right. So boiling it all down, the Q1 story from Chewy, based on these sources, is really one of strong internal execution. They beat expectations, they're growing nicely, driven by core strengths like AutoShip, but also these newer initiatives, Chewy Plus, the vet clinics, that high-margin ad business, they're taking market share, building this whole ecosystem.
Yeah.
But the market's reaction was kind of meh, maybe because of those valuation issues, the stock's volatility, or just broader economic jitters.
That really captures the tension, I think. Solid company performance running into a bit of a cautious market wall, maybe.
It definitely leaves you with something to think about. Chewy's strategy seems so focused now on building this deep loyalty, this whole integrated ecosystem, retail, subscription, healthcare, ads. It's way beyond just selling products. So the question for you, listening, is maybe. What does this strategy tell us about where specialized e-commerce is heading? How vital is that kind of deep integration, locking customers into an ecosystem for surviving and thriving long-term, especially when you're up against giant generalist competitors? That ecosystem focus feels like it might be the key differentiator for them going forward.